What's going on? Welcome to my channel. I am the covered call guy, and for those who are new, welcome to my channel. My goal here is to create $120,000 in annual passive income using covered call ETFs. Right now, my projected annual dividend slash options income is about $82,000 a year, 6.8K a month, 1.5K a week, $226 a day, and about $9.42 per hour. Before we start this video, legal disclaimer: this content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and it may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube and I could be completely wrong. Now, with today's video, it's going to be more of my projected bias onto you guys because I do talk about it a lot, and it's going to be about the efficient income zone. All right, so I'm going to be talking about the framework for us covered call and income investors. All right, my thesis for this video is how to optimize the yield spectrum for structural durability. Because if you're new to this channel, welcome again. I talk about the long-term hold, the semi set and forget, right? Because of course these are actively managed. We have to keep track of it, right? Every other day, or if you can't have the time, every day. For the most part, we try to hold. I'm trying to hold for at least 30 to 40 years. Yes, with cover call ETFs. So we do have to really set ourselves up for that sustainable, reliable, consistent future, right? So I'm going to show you why all cover calls are not created equals. I say this a lot on all my other videos, but I'm going to get started on that. All right, so that's my hook for this video. All right, so let's talk about the income substitute, right? This is the revolution. This is what really started in the last 2 to 3, pushing going on 4 years now, right? So the shift started when bonds really start to fail to beat inflation for years, right? So we kind of move into the substitute. The vehicles for this was really, higher dividend stocks, income ETFs, and specifically cover call ETFs. This is where we're at, right? The JEPI, the JEPQs, and the QYLDs. These were the biggest and most popular ones that really took everybody. These were the titans, right? So everybody kind of knew about them firsthand. But with these higher yields, this is the flaw, right? We treat these tools more as a monolith. We assume income is income, and that's where a lot of people get the wrong idea, right? So this is my findings. I'm gonna tell you right now, I said a lot, this assumption is dangerous, right? The structure of the yield matter more than the yield itself, right? So setting up, we're replacing safe bonds with more complex derivatives and calling it safes. So don't do that. All right, so income is the exhaust, not the engine. All right, so for those who are not new, I talk about this a lot. So, and for those who are new, what is the engine, right? I talk about what's underneath. Think about your portfolio as a car, right? What's underneath the hood? How is it operating? How are you moving forward, right? So, let's talk about the inversion. Most investors start with I need 10% yield, so they accept whatever leverage, negative convexity, or NAV decay is required to hit that number. Right, so this is the EIZ, efficient income zone way. Income is a design parameter to be optimized, not maximized. So let's just say that again to yourself, right? Yield is to be optimized, not maximized. I say this a lot in all of my videos, and probably every single video I will talk about it. And for those who's been around, probably get tired of me talking about it. But my channel is growing. I got new viewers watching me, and I just want to emphasize this point a lot, right? It should be the byproduct, right? The exhaust coming out of your car over a resilient portfolio structure. That is what we should always be aiming for. And in my previous video, I did say, yes, you can start building out your portfolio and with the 30, 40, 50% yields. But as you start scaling those and start having a set, a set goal, right? I want 100 or 500 shares, or I want, $50,000. And once I hit the $50,000 mark, I'm going to start divesting into more stable, lower, consistent yields. That's okay. That's okay too. That is fine. As long as you have a strategic goalpost of where you're trying to be at and how you're setting yourself up, right? So my thesis again is if you force the yield to 12%, you often break the machine, right? Your car gives out and then you're stuck. right? So the income fragility curve, right? This is the portfolio level here, right? So in zone one is the incidental, right? This is under 3%. This is your growth focus, efficient but behaviorally fragile, right? Of the sequence risk, where if you're living off the less than 3%, you're most likely not living off that 3% unless you have a, I'm gonna say, a $5 million portfolio, then yes. But for us income investors, cover call ETF investors, for most of us, we're gonna be retired with anywhere from $500,000 to $1.5 million, right? That puts us where we're living well above six figures. Zone two is the efficient zone, right? This is your 3 to 6 percenters. This is your optimization vertex here. This is max Sharpe ratio and capital retention. This is where you should be kind of lowering yourself as your portfolio matures and grows, right? As you grow and mature in age and as an investor. And then zone three is your fragile zone, where most of us, probably 90% of us, myself included, is where we're at the 8 to 10% zone, right? So this is where it becomes a manufacturer yield, right? Not necessarily bad. It doesn't mean it's bad. It just means that most of these higher yield doesn't come from organic dividend, traditional dividend payouts, right? So this is where negative convexity and NAV decay can happen. So you have to map it out, right? Risk rises slowly, then all at once. So you have to have a roadmap of where you're trying to be. If you're watching my video and you're 18, 19, 20, 21, 22, and 23, right? Under 18 to 25, right? This is where you can take the most risk. This is where, if you're starting out, sure, maximize your yield. Go for the 30, 40, 50 percenters. I wouldn't say do it all for, not from 18 to 25, right? Maybe do it for the first 2 to 3 years. Get your foot wet, understand where you're trying to be, play around. This is where you can be the most aggressive, right? Because you have time on your side. And then as you start maturing, you're going into your 22 to 25 to 26, 27. This is where you want to start dialing it down and be like, okay, I'm approaching my 30s now. Where do I want my stable yield to be? Where's the, your Goldilocks zone? And this is where you start kind of really mapping out for the next 30, 40, 50 years. All right. Oh, it got cut off, but no worries, right? So this is the covered call yield spectrum, okay? All right, covered call ETFs are not a monolith, right? Treating them as one category is anatomically incorrect. So let's look at some of my favorites of the 5 to 7 percenters, right? GPIX and GPIQ, right? These structural risk profile is more conservative, out of the money, right? Partial upside retention, low convexity loss, and legitimate efficient income zone, right? This is where you can have them as your core satellite core, right? You can even play them around with your satellite. This is fine. You can have a small percentage and build elsewhere. And then 8 to 10% is your JEPI JEPQ, right? This is your diversified overlay. Now you're starting to have more moderate convexity loss, volatility harvesting, and standard income too. Then you get into your 12 to 30%, right? These are where your SPYI and QQQI. These are your more aggressive overlay, right? High negative convexity. You could end up having a higher chance of NAV risk if not managed actively. I'm not saying SPYI or QQI have any of these, but once you start getting into the zone, then you will start seeing, okay, whoa, I gotta start, chilling out on adding too much 15, 20, 25, 30 percenters, right? And then of course you have the 30 to 100% plus. These are your YieldMax, your leverage, right? Your Rex shares. These are the more conversion instruments. Extreme path dependency, systematically exchanges return potential for cash, right? So my verdict here is the highest tiers are not investment, they are cash flow converters. Understand that if you get into YieldMax, you want to be, if you start out here, there's nothing wrong with starting out here. I'm probably gonna get a lot of hate for saying this, but if you're starting out, if you're new and you start out here, that is fine, as long as you have a goalpost and a your strategy of spilling over that distribution and leftovers. And if you want to you're positive on your gains, selling off a little bit to spill into the lowers, right? That way you have a more stable. So starting out in a 30 plus percentage, as long as you know that you have a game plan to kind of compress the yield where it's sustainable, reliable, and for the long term, that's fine. All right. So zone one, Why just buy SPY doesn't work for us, all right? For us income investors. Yes, you have capital appreciation, right? Zone 1, where the yield is less than 3%, relies on the price going up to eat, all right? Everybody's got to eat, right? I must sell shares. Of course, this can also lead to the sequence risk, right? If the market drops 20%, I sell shares to pay rent. I am permanently impairing my recovery. This is called reverse and dollar cost averaging, right? This is the opposite of DCA. Right? It is behaviorally fragile for retirees and income investors like us. This is the problem, right? Mathematically optimal, but emotionally impossible when the market crashes. Look at zone 2. This is the what I would like to say the efficient income zone. 3 to 6 percenters, right? This is the optimization vertex where risk adjusted returns are maximized, right? So defining the EIZ at the portfolio level, right? You don't need every stock to yield 4%. You need to build a portfolio that yields 4% in aggregate, right? So the vehicles for that is dividend growth like VIG, aristocrats, and conservative out of the money calls like GPIX, right? Structural advantages is that payout ratios are 40 to 60%. You have companies that retain earnings to grow, and this growth fuels future income, right? Inflation pass through. And of course, it gives you the behavior advantages, right? Income reduces panic selling without capping upside. So this is the goal where if you're new, right, this is where you want to survive the full market cycles without having to sell, panic, and just be fearful. Right, zone 3 is where I would say this is the conversion zone, right? This is over 10%. All right, so this zone is dominated by manufacturer yield, right? YieldMax, aggressive at the money calls, right? The trade-off is, yes, you're selling convexity, right? That's your upside to buy certainty, which is your cash, right? The risk, negative convexity, capped upside, NAV decay, right? Destructive return on capital, and liquidity dependence, right? Important distinction is that, again, I'm going to say these products aren't bad, but they are fragile if they are your core holdings, right? They are a tool, not a foundation. There's a warning again. Don't ever mistake a conversion instrument for a compounder. Separate the two. Right? What's risk 1 with negative convexity? We're going to look at the 2025 case, right? So for scenario, S&P 500 rips 17.9%, right? 2025 year to date. What happens to safe income? Well, look, S&P 500 was uncapped. You got the full 17.9% gain. If you had at the money covered call ETFs, all you got was about 2%. This is the cost. Investors in the fragile zone, right? Zone 3, forfeited nearly 16% of the upside capture. Income stability was purchased by selling long-term compounding, right? And it's the reality of it. In a bull market, safe income strategies are extremely expensive. What's risk 2, right? So the liquidity vacuum here is looking at August 2024. This was the event that happened August 5th, 2025. VIX spiked to 65.73. No macro shock, just the market plumbing breaking, right? The mechanism behind it was by analysis by the BIS revealed the spike was driven by illiquid out of the money puts, right? So market makers widened spreads to over 80%, right? So this mechanically inflated the VIX, triggering forced deleveraging and volatility harvesting income funds, right? The lesson learned here is if your income depends on continuous derivative liquidity, you have a hidden tail risk, okay? Understand this because this is important. And I can this, I guess I should put more information on the slide, but just think of the stock market as a busy playground where kids, us, right, we're trading toys with each other. Normally everyone trades smoothly, right? We have a buy and sell, and prices stay steady, right? Think of who collects cards. Think of it that way, right? Then one day some rare cards, in this case, right, the options called out of the money puts become very hard to trade, right? That's the illiquid part. Almost nobody wanted them, so price gets weird, okay? So the entire card game gets weird. And then the people who help run the playground, right, the market makers, had to suddenly raise their price a lot just to protect themselves, okay? This made it look like everybody was panicking, even though no one really was, like kind of like a false alarm. This happens, of course, right? This is the market. All right, so this false alarm basically showed that if your market depend on trading things easily, like those special options here, right? These hedge funds have special options, right? You might be hiding a big risk that only appears when trading gets tough. So us income or cover call ETF investors do have to worry about this part. Okay, this is one of the reasons why you have to dive. Reasons why I started out, hey, when I reach my $120,000 a year goal, I'm gonna divest into something else, maybe traditional dividends, to kind of have that buffer. That's my buffer. All right. Is 12% yield always bad, right? Let's look at SPYI versus YieldMax. When is it acceptable? Well, funds like SPYI and QQQI differ from single stock yield traps, right? They have an index diversification and active management. Use that as satellite if you want to. It could be even anywhere from 10 to 20% of your portfolio. They are structurally credible tools to boost income. When is it destructive? Well, fragility emerges when these become core holdings, right? The danger isn't the 12% itself. The danger is designing a portfolio that requires 12% to survive, right? That dose is what makes the poison. And I'm not saying SPY and QQR is bad. I'm just saying in general, where you're forcing that 12% with anything, that's when it gets destructive. All right, so how do you end up drifting out of the zone? Because a lot of us, you know, it could happen to all of us, and I can admit it probably happened to me too, right? Investors really jump to fragility, right? They drift there. We don't just want to go and get into the danger zone. Nobody does, right? How do we drift there? One is anchoring, right? You tell yourself, I need $5,000 a month. Yield drops. I don't cut spending. I swap the safe stock for a more risky 12% fund, right? The distribution illusion, right? I see a steady check. I ignore the NAV decay. The income is constant, but the wealth evaporates. And then 3, the spectrum slide, right? I start with GPIX, right? I stay conservative. I talk about being conservative. Then I slowly move on to JEPI because of high yield. Then I'm all in on YieldMax for the synthetics. So I slowly keep creeping up, right? That's the trap, right? You solved an income problem by creating a solvency issue. All right, let's look at the yield migration strategy, right? And I always stress this. It is okay, again, to use the fragile zone as a launch pad, but not a home, right? Let's look at the 40%. This is the launch pad, right? Use high yield, such as YieldMax, to generate massive cash flow acceleration. But learn to migrate, right? This is your pivot. Take that cash flow and buy low beta stable assets. And then again, move downwards again to your 12% or less. This is your fortress, right? End with core holdings in the lower 10s, right? This is where it's more structurally sound. Right? This is my strategy right here because I always stress it. Right? Start at a 40% to build the pile, move to 12% to keep the pile. Right? It's not what you make, it's what you keep. All right? This is my blueprint, of course. Again, don't rip me for this. I just talk about this for those who are new and want to get their foot into cover call or income investing. This is my blueprint for the so-called the modern income portfolio. This is just an example again, an example. All right, so let's look at your core where it build up your, which should at least make up 70 to 80%, right? This is your foundation. I would say here, use 8 to 12%. This is your core here, right? Structural income like SPYI, QQI. You can use a volatility harvesting like JEPI, JEPQ, right? These are structurally sound, diverse, and actively managed. And then you have your satellite, which can make anywhere, depending on your risk tolerance, could be 20 to 30% of your portfolio, right? These are your accelerators. These are the yields where it's 20 to 40%, right? We can get into sector specifics like IWMW, IVVW, DIVP, or very specific SRHR, right? And then you have your ultra high yield with SMCY, which has a 200% plus yield, right? Use them as a tactical booster to supercharge cash flow. Nothing else, right? The strategy here is use your satellites to supercharge cash flow, but rely on core for structural stability. Don't ever get greedy. Don't ever think it will always be safe, right? That income you get this month may not be the same next month and may not be the same, 6 months and 6 months in a row. right? So my golden rule for income design is one, target the modern range, right? Aim for 10-15% portfolio yield. Use satellites to boost your structural core. Two, always, I say I love it, prefer organic income, right? Payouts should come from earnings slash premiums, not return of capital. The best you can, of course. It's not always that easy, right? Three, limit negative convexity, right? Understand that selling calls capture recovery, keep it tactical. Four, stress test liquidity, right? Don't rely on illiquid option markets in a panic, right? The lesson here is August 2024, especially if you knew you would have you would have panic sold. Number five, design for survivability. Always never forget that income should reflect strength, not concealed weakness. And I will be making a video on how to do this. Yeah, I definitely will. All right. Just hope you guys do want something like that. I have something in mind. All right. So the end game here is that the efficient income zone is not anti-income. It is anti-fragility, right? We don't want to be fragile. And hopefully, did I save your portfolio? Smash that like button and subscribe. Comment below. Or you strictly core or you dabble in the synthetics? Because I know some of you guys are building up. I've read some of the comments here that you guys are starting out in the 40s and 50s. There are few of you, and you guys are new too into the income investing, which was very surprising to me, because you watch my video and I always go. But again, it all depends on your risk tolerance and how much research you've done outside of watching my videos. So let me know. I'm always shocked to see somebody comment something. Of course, hopefully, you're not just typing to type it, because I read it and I'm sitting here. I'm thinking, oh man, either this guy is insane or this guy's really smart. So hopefully a little bit of both, right? Because that's what I am. So thanks for watching. Stay tuned. Catch you guys in the next. You guys are the best.